Hi, and welcome to week 5 of food cost accounting. We are almost done. We have one more week ahead of us. And now we're going to broaden our understanding of all of the accounting it takes to actually run a food service operation. So let's get into it. Our learning objectives today are to touch on beverage costing. It's going to be very similar to food costing, but with just some different ingredients. So we're going to go walk through that, the cost per beverage, and then selling price. And then we're going to talk about another pricing method we haven't seen yet. So far we've been focusing on food cost percent pricing using a projected or desired food cost percentage to price out all of our menu items. We're also going to learn about the contribution margin pricing method. And then from there, we're going to conclude talking about a lot of the different business expenses that we see in food service operations. So, the types of expenses, the COGS formula, which is cost of goods sold, which primarily refers to food and beverage. But the formula is essentially the same for everything else that the business experiences if you wanted to represent that as a percentage of its sales. And then we'll talk about inventory management, budgets, labor cost, and then conclude by introducing the POS system, which in this day and age is our lifesaver, is our lifeline, our complete support of food service operations. Luckily, we don't have to do everything by hand anymore. But it's important that we understand all of the math behind it that is supporting these POS systems. POS means point of sale, so we can catch errors because occasionally there are errors on the machine's end. So let's do beverage costs first. So again, like I said, it is similar to costing food. We still need recipes, definitely need portion sizes, and apply the yield percentages when needed. So if you're using any fresh ingredients, definitely anticipate having a yield percentage. Most specifically and costly is citrus juices because you're buying a whole piece of citrus, but you're only getting a fraction of its weight in juice. So that is going to be a huge cost to consider. What is the biggest difference from costing out food is that spirits, meaning alcohol and wine, are often purchased in liters. So we will have to do some conversions to US standard system to make that costing process easier. However, spirits are often sold in similarly sized containers, being like liters or 750 milliliters. So you'll just see those numbers repeating, and then you'll kind of just have that conversion programmed into your brain after a certain point of doing it so much. And factors that also affect selling price. So this also applies to food as well. We're just kind of now talking about it with beverage costs. So this is everything that you'd want to take into consideration when setting a selling price. Obviously, the demographics. Who are your clientele? This is a fact that cannot be ignored, and this goes beyond our math portion, so I can't get too much into it. But the age, gender, main occupations, location, and income of your clientele deeply, deeply impact how much or how little you need to set your selling prices at to be successful. Obviously, the type of establishment you're running, because we're talking about beverages, I kept it beverage related. So, a dive bar versus a cocktail lounge. You're going to have cheaper drinks at a dive bar, and you're going to be using more fresh ingredients at a cocktail lounge. So, you should expect to see some higher prices. And then, of course, analyzing your competition, you need to make sure that you don't stick out like a sore thumb for any reason. So, putting yourself right there in the middle, making yourself competitive with the local businesses is smart. So, often beverages are earning more money than food because the ingredients are relatively low in cost. Most of the ingredients you're already purchasing ready to use, i.e., the spirit involved or the main syrup involved for like sodas. Um, and then your fresh ingredients are just a bonus on top of that. but a lot of the ingredients bought for beverage making are shelf stable, have really long shelf lives, and have low pour costs as well. So the portion of alcohol that you're getting is actually very, very cheap in comparison to the bottle. And that's why we can make so much money off of beverages, because the collective ingredient cost is very low. And also, there is less labor involved. There's less prep time because we're purchasing things that are already ready to use or have minimal prep time. Not a lot of skill is required in that. Not to say that bartenders aren't skilled, just saying the prep involved for making beverages aren't very skillful labor, like juicing citrus, peeling um, citrus, what's that called? Peels, I guess, for garnishes, making all those different garnishes, making syrups. It's following a recipe, not messing it up, versus cooking, where so many different things can go wrong. um, yeah, there's a lot at play when we're cooking. So making beverages just has less labor during prep time, but also less labor during service, meaning we don't need as many cooks as we need bartenders. However, the bartenders need to be skilled, so that's where we compensate for in pay. Also, if you look at the amount of customers that are able to be served per minute, per hour versus bartenders and cooks, obviously bartenders can create drinks in under a minute, and therefore they are serving more customers per hour versus a cook, where they are dependent on their protein, the item that they're selling, to cook or to be ready, and it takes longer than that minute that the bartender is taking to make a drink. So there's more efficiency in serving many customers in little time. Um, though these two uh, costs in a business are lumped together eventually, they are tracked separately for quite some time, up until that month end, when then you're taking into inventory into account, because beverages have that high margin for profit. So if you combine them prematurely, you're going to run the risk of masking any um, hemorrhaging that a food cost might be having on a business, meaning there is a really, really high food cost, but when you combine it with the beverage sales and costs, it kind of averages out, and then you don't really notice what's going on unless you have taken a further look into it. So do keep these costs separate. Obviously, the bar might be going into the kitchen using some products. There is some crossover there. It's kind of a gray area. Do your best to keep the charges separately. For example, like sugar is the biggest ingredient that bartenders will come back to the kitchen to use. However, it would be beneficial if both bar and kitchen had their own sugar resources, so you can completely track the use. And then in the end, when you're taking inventory into account, that's when both front and back of house come together and then average out, but you don't want to do it up front. So you might see see some familiarities in these formulas, because it is very, very similar to costing out our foods. So, like I just mentioned, most of our establishments are tracking food and beverages separately, but they are added together to account for the cost of goods sold, aka COGS, and we'll get into that a little bit later. Industry standard for beverage costs ranges from 18 to 24%. However, this highly depends on the type of business that you're running and the beverages that you're selling. If you're just beer and wine, you can, price differently than a cocktail lounge. Also, when you have spirits involved, you probably have a ranking of spirits, meaning you have your well, you have your premium, ultra premium, however you want to label it, but you have some choices for the customers to make. And when you have those choices, those alcohols are then not held to the same standards. They are priced differently, and you'll want to use a tiered system to organize that liquor by its quality. So, we do use beverage cost percentage to set our selling prices. It's the same concept as our food cost percentage. And this is what's giving us that baseline price to ensure the overall beverage cost for the business is maintained. So to find how much a single beverage costs, you're going to take that recipe for the beverage and you're going to add it all up. That's going to give you the total beverage cost. You're going to divide that by how many servings it gives you, and that is how much a single glass costs. Then take that single glass cost, divide it by your ideal beverage cost percentage. If it's that lower one, 18%, because remember, lower is better, but that means a higher cost to the customer. Then you will get your selling price from there. So, similar to food cost, instead of beverage, it's literally just how much that single plate costs us divided by our ideal food cost percentage, and that gives us a selling price. So it's essentially the same formula, just different words. Here's a quick video just so you can see it illustrated in real time. Hopefully it plays and we don't lose the audio. I really, really hope.
In this video, we're going to learn how to calculate the beverage cost percentage. We're going to begin with the beverage cost percentage formula, which is beverage cost divided by beverage sales times 100. Let's try to calculate the beverage cost of this cocktail. Let's assume that the cost for producing this cocktail is $1.35 and that we sell this cocktail for $7.50. To calculate the beverage cost percentage, we'll need to take the $1.35, which is the cost of producing the cocktail, and we're going to divide it by the selling price, which is also the beverage sales. Once we divide the cost by the selling price, the result will be 0.18. We're going to take that number and we will multiply it by 100 to convert it into a percentage, which will then give us the beverage cost percentage of 18%. For videos such as this and more, please subscribe to our YouTube channel.
So pretty simple. Like I said, we should feel familiar with that. So here is another example. This includes a short recipe. So this looks like for margarita. We have tequila, triple sec, lime juice. We have our unit of measure, 2 ounces of tequila, 1 ounce triple sec, 1 ounce lime juice. It looks like they are just purchasing the lime juice. Boo. But hey, I don't judge sometimes. So anyways, freshly squeezed citrus juice is always better, but it is a higher cost. So this might be at like a dive bar where they're not, taking the time to squeeze the fresh juice for their customers. So, however, um, this is where we're going to see that metric system come back to haunt us a little bit. But like I said, luckily for us in this business, these spirits are sold in similarly sized bottles. So once you get that conversion down, which I wrote for us here, 750 milliliters is 25.4. You know, you have the resources to do this math. You also have Google. Yeah. So you have all the resources. You don't have to do the math in your head or do it on paper. You can just ask Google real fast, hey, what is 750 milliliters in ounces? And it'll give you that conversion for you. So I broke it down here by the ingredient as well. So I'm taking the cost of the bottle divided by how many ounces are in that bottle, because our unit of measure in our recipe is in ounces. Now, if this was in milliliters, we wouldn't have to do that, but it's in ounces. So that's why we were using the ounce conversion here to discover how much it costs per ounce from that bottle of tequila. We are then taking that price per ounce and then multiplying it by how many ounces are in the recipe. So in each drink, there is a total of $2.38 of tequila. Triple sec, same thing, and sold in a 750 milliliter bottle. So I replaced that with the 25.4 ounces. The bottle costs $18. There's 25.4 ounces in it. So that leaves us with 71 cents per ounce. We're only using an ounce in the recipe, so we are using 71 cents of triple sec. Lime juice, luckily this was already in ounces for us, so I just went ahead and went with that division problem. $6 is how much it costs us to buy a quart, and that leaves us using 19 cents per ounce. And again, we're only using an ounce in each cocktail, so we're using 19 cents worth of lime juice. I'm going to add up all of those costs together for the specific amount that we're using in our recipe. That leaves us with $3.28. And just to showcase what a 20% food cost on the, beverage cost would look like for this drink, we would need to charge at least $16.40 to have a 20% food cost on our cocktail. So that's where the price gets hiked up, that food cost. We need to price our drinks accordingly so they help us pay for all of our other business expenses. So, this is where the lesson is going to get a little bit more conceptual, meaning we're not having a lot of hands on math today. In our lesson, at least, I'm going to be talking a lot about of our different business expenses in the industry. And then there'll be some formulas. We're going to practice with these formulas in class. But the lesson in its entirety is, mm, I'd say about 85% conceptual. So that just means that we are learning about these costs. So let's get into it. Tracking trends is what is going to lead you to profit. So it's not just about costing an item, pricing it, and then selling it. There are ways to even place those menu items on the actual physical menu and attractive pricing methods, which I've already kind of talked to you guys about, that make items more intriguing to purchase. So it's a whole psychological effect that you can have with your menu. Your menu is a guide to the customer, and there's a certain way you can use that menu in your benefit. Another way that you will want to increase profit is to make sure that your staff is fully trained on how to upsell items, how to include items in combinations, or to just completely advertise specials or those items that you want to see move more because they make you more money. And of course, don't forget about advertising. In the age of social media, we can save so much money by running our own social media pages or even having influencers come in to advertise to get our name spread. Don't ignore old fashioned media sources, newspapers, community magazines, flyers, billboards, the little chalkboards outside your restaurant. All of those things matter and they can definitely help to bring clientele in. From there, what gets more tricky and what is the POS system, our point of sale system, is so beneficial in doing is tracking what's happening with our products. So this is going to help us control costs, and then therefore we can improve our profitability because we can adapt. So it's important to monitor sales, what you're actually moving through your restaurant, your inventory, what is coming in, what is leaving, and then, of course, the product quality. Because when you're working with produce or fresh ingredients otherwise, they are all different. They are subject to change, especially based off season. So you want to make sure that you're actually getting what you're anticipating or those yield percentages are actually matching yours. Don't forget to price check and shop around for deals. Often businesses are paired with multiple purveyors, aka suppliers. Double check with those websites between them. What is the better deal? Sometimes those purveyors are running specials or sales, and you want to take advantage of those sales to save yourself some money. And of course, training your staff properly and offer retraining, especially if you notice those yield percentages going down or you're noticing a lot of waste or just some money missing every time a certain individual works. You'll want to follow up with that and double check that everything is going according to your standards. And of course, this is why we threw those dates on our cost sheets when we did our food costing. You'll want to update prices when necessary. So keeping track of the dates, keeping track of those items that are subject to change will help you know when it's time to change the prices on your menu. So those pricing methods that I mentioned. So one, that food cost percentage pricing. This is what we've been focusing on so far. This is applying a certain cost, I guess, a certain food cost percentage to all menu items, and you'll want to then use that preliminary selling price that first calculation gives you to adjust the menu item, whatever it is, being food or beverage, to match its perceived value. So if that preliminary selling price seems too high for you, meaning you're afraid customers won't pay that much for that item, you'll have to lower it but then compensate with another item somewhere in the menu that has a high perceived value and customers are willing to pay more money for it, but it doesn't cost you that much to make. So that's where that averages out. However, this is a really tricky method to do your entire menu with. So this is where contribution margin pricing comes in. And there's two ways of looking at this. So one, you can attach a base price to all menu items or the menu items that you want to price in this method in order to cover the cost of business, meaning whatever it takes to run the business for the month and your ideal profit for the month as well. So we'll see this in a minute. Don't let the first sentence confuse you. Another way to look at contribution margin pricing is to analyze the difference between the menu item's selling price and the cost of the ingredients. So you're pretty much taking selling price minus cost of that single dish and then looking at that number left over. That's the money that that item is giving you to then pay for other expenses in your business. So often businesses are using a combination of the two methods because both methods are not perfect on their own. So the best way to go about it is to use both of these methods for specific items or however the chef and owner see appropriate. So the limitations that we see with food cost percentage pricing, because the it is based off the cost of the food being a certain percentage of the menu price. This is going to leave a lot of varying amounts of money left to cover other costs, especially those items that have a low perceived value. We have to change the price to make sure that the item is actually moving. We are going to have less money to work with that item. Also, because ingredient prices are fluctuating, but we're not printing menus every single day to match those prices, that would not make customers happy. We do have to have some consistency. So, we do at times, because of market prices, end up earning less money when the prices change. Also, the popularity of menu items vary as well. You always design a menu, you're designing recipes in the hopes that everything is going to be perfect 100% of the time, everyone's going to love it. You put it on at a certain price with a certain food percentage, but then it's falling flat and you're struggling to sell it, and the customers just they know what they want. So sometimes, despite your as the restaurant owner, the restaurant chef, just despite your better interest, the customers do not fall in line with that. So you have to be able to price things differently sometimes to make sure that you're actually going to make some money. This is where we see contribution margin pricing coming into play, and definitely places that are like considered fine dining or upscale restaurants are going to use this method because this is a foolproof way of getting a set amount of money, a guaranteed amount of money per customer because they're helping pay for a chunk of the cost of business and your profit that you want to see in a month. So this is what contribution pricing is. It's a technique based off the cost of business and desired profit. You will then take those two numbers as they are added together, divided by the average number of customers you see within a month, and then you're going to get this base number, this base monetary value to attach to each menu item. So this is definitely going to ensure a profitable business because each customer is paying their portion to give you overhead costs and profit at the same time. Then you're going to attach the menu item costs, whatever it costs to make that single dish or single drink, and voila, you have money coming in. It's flowing endlessly. However, you'll see higher costs here, and that's the struggle with this method of pricing. So, for example, um, and this is always done by monthly. This is how businesses are tracking their expenses. So monthly cost of business, we'll go into later what that exactly means, but let's just say it per month it takes us as a business $25,000 to run. But on top of that, we want to be making at least $5,000 a month. So we see our total monthly costs as $3,000. We have an average of about 2,000 people. So when we take $30,000 divided by our 2,000 people, we are going to charge each person $15 per menu item as soon as they walk in, because at least we are going to guarantee that they are paying us for our cost of business and our profit. So let's see that work out. Example, these are just two random menu items. This is the cost per plate. So both are costs $4.55. With that contribution, which we just worked out of being $15 plus the food cost of that single dish, this is our preliminary selling price, $19.55. Taking that menu price in comparison to our actual food cost percentage, or excuse me, our actual food costs, this is our food cost percentage here. We are operating at a 23.3% food cost, which is really good. We like to see things under 30, even better under 25. Versus we just slap on a 30% food cost here to that same menu item that costs us $4.55. And we're looking at a preliminary selling price of $15.17. Now, this isn't to say that whoever is working the menu prices looks at this item and says, no, we have a higher perceived value for this menu item. Let's go ahead and upcharge to something like this number here. And then in the end, we have a similar food cost percentage. However, this is that preliminary selling price at a 30% food cost. So we can see the price differences here. This barely just covers that contribution margin that this price already includes. So it's up to the owner and chef to decide which is going to be most beneficial for their establishment. So we can see it work out differently here. So a ribeye steak, notorious for having a high food cost percentage. This is why we see 40% here. However, this looks like it's just the steak sold by itself. We can anticipate someone purchasing another side to come with this. So that was where we could upcharge on those sides to make up for the difference of that 40%. However, the contribution margin here, so not taking into account our monthly sales and our monthly profit, we're just looking at the difference of our menu price and our food costs. So $40 minus $16, that leaves us with $24 of contribution margin. And if we can see the difference in 500 sales, $24 times 500 sales, this steak can make us $12,000. That's pretty good. Compared to an Alfredo pasta, the menu price is $22. We have a 25% food cost, which is great. We'd love to see that. So it only costs us $5.50 to make, but $22 minus $5.50, we only have $16.50. So across 500 sales, we're looking at only $8,250 made off of that pasta. So difference in here, it highly depends on the item, but they do benefit from having that higher contribution margin here. We are making more money off of this, even though we're seeing a higher food cost percentage. So this is our cost of goods, aka COGS, cost of goods sold. This is the combined cost of food and beverages. This is going to define how successful a business will be. And this revenue must pay for ingredients and the operating expenses and the capital expenses. So operating expenses include labor and benefits, so everything for the employees, the china, glassware, flatware, linens, the plates, glasses, silverware, and also includes paper products. This will also cover administrative and general expenses if you're spending any money on marketing, and any expenses to cover operations and maintenance, especially to the building, and utilities being all the electric bill, water bill, picking up the fryer oils, that kind of stuff. Capital expenses are hard expenses, meaning you can't really control them, versus operating expenses. There are some areas in which you can control a little bit more. Capital expenses are insurance, rent, real estate taxes, interest expense, depreciation, everything you need to account for. And anything left over is where we are making our profit. So we can see why math is so important in this industry because we have such a razor thin margin to make any profit. So this is what we could see in a typical monthly expense for a restaurant. So this does not include any potential profit because we're just looking at operating costs. So we see the biggest chunks immediately going to staff and then food and drink. Those are both at 30% for this restaurant. Rent and what's another one? Miscellaneous overhead costs being at 12%, and then utilities, repairs and maintenance, marketing, insurance licenses, and that POS software. It is a lifesaver, and we do have to pay for it, unfortunately. But these are all of the costs that the food is paying for. So the next time you go to a restaurant, if you didn't know this, and you're wondering why do things always cost so much when you go out to eat, this is why, because you're not only paying for what you're eating, you're paying for the entire atmosphere in which you're in. It's a lot. So this is the COGS formula. And again, this is based on total food and beverage sales in a certain time frame, usually done within a month, but you can use your POS system to scale it down or widen it however you need to. The total cost of food and beverages should always be less than its sales. If you're paying more for what you're selling, there's a problem. And ideally, we're trying to keep this under 30%. Under 25 is better, but 30% is pretty much a industry standard. So to get the total food and beverage costs, you do have to take into account your inventory. So this is something that we have not talked about yet. So you're going to start with your beginning inventory, which is where you started off with your inventory last. You're going to add in any purchases that you made, and then at the very end, you will count what is left over in your inventory so you can see what moved. And this is where you're getting that total food and beverage cost. And just in case if you didn't know what inventory was, this does include counting food and beverage items in storage and then multiplying the number of those units, so whatever you have on hand, to the as purchased unit cost. So this is like where we were practicing in our food cost sheets. Remember having that same unit of measure. So if you have a pound of flour in your restaurant, you want to price it out by its pound. But if you're working with ounces, you want to have price per ounce, all that good stuff. So the formula is cost of goods sold is equal to the total food and beverage cost. So how much you paid divided by the total food and beverage sales, how much revenue you brought in from selling those items to customers. In shorthand, we have COGS equals cost divided by sales. And we do have a video to watch. And again, I really, really hope it works. This is actually a really good one, so I'm going to let him do all the talking.
Have you ever wondered what the actual calculation is for cost of goods sold for your restaurant? Maybe one of the most important calculations you're ever going to do in your business. I'm going to tell you what it is in just 1 second. Hello, this is Dave Scott Peters with therestaurantexpert.com, and I got to tell you, knowing your cost of goods sold could be one of the most important things you're going to measure in your business. And to measure it, you have to have the right equation and the right information. So how do we do this? Well, it starts off with knowing your beginning inventory. Beginning inventory is what was on the shelves the last time you counted. Well, that means we have to be taking inventory minimum on a monthly basis, preferably on a weekly basis, to know the value of everything on the shelves. That includes all of our batch items, meaning desserts, side dishes, soups, anything that I manufacture myself. For instance, if I have a tenderloin, I cut it up into fillets, that isn't in transit and gone. That would make my food costs higher. I need to have a value for each one of those fillets that I can count it. So I have a beginning inventory of all the products that I have on there. By the way, paper supplies aren't a part of it, janitorial's not a part of it, smallware's not a part of it, only the food or only the liquor, bottled beer, draft beer, wine. We're going to do cost of goods sold by category. In this case, for cost of goods sold, let's just say food. all the food that was on the shelves last period. Well, I'm going to add to that all of my purchases. Anytime a vendor comes in and drops off any product, whether paid for or not, it is an expense that period. We're on something kind of accrual accounting system, earn OUs. Means when the sale comes in, whether I collect the money, it's a sale based on the IRS rules. Whether I pay for a product that I bring in, doesn't matter, it's an expense. And then use. It's an adjustment in inventory. If I used more than I purchased, I take it from inventory, increase my cost of goods sold. If I didn't order, I ordered too much and I take it out of expense, put it on the shelf, it reduces my cost of goods sold. So earn OUs. Beginning inventory plus purchases, whether paid for or not, gives me a total, how much money I have on my shelves that I could sell. That also means that if I had $5,000 on the shelves when I opened my restaurant, brought a delivery in of $10,000, closed the restaurant, didn't open till the last day of the period, called the 31st, well, I'd have $15,000 I could sell. Beginning inventory plus purchases gives me total available. Then at the end of the period, by the end of that Sunday or last day of the month, again, I'd rather it be a Sunday, we count what's on the shelves for full value. Beginning inventory plus purchases, total available, minus ending inventory gives me use. That is my cost of goods sold. Now, how do we use product? Number one, we hope we sell it, but it could be stolen, wasted, spoiled, and it could be you've decided to take it home with you. Meaning as an owner, you took tax advantage of your business, had a barbecue this weekend, took some ribs, some burgers, some Jack Daniels, a keg of beer. Well, that's going to drive your manager's cost of goods sold up. I'm not telling you not to do that, but make sure it goes on a waste sheet that when you tell them their food cost is high, they say, no, I'm in line, you took some product. But see, the equation beginning inventory plus purchases minus end gives me use. Use is blind. It has no idea where it went. So we need other systems. Now we take our total product used divided by the sales for that same period. We come up with our food cost, poor cost percentage, our cost of goods sold percentage. So if I come up with a 30% food cost, that means for every dollar in food sales that came in, I use 30 cents in product to bring that dollar in. That's your cost of goods sold. It's an incredibly vital part of your business, a piece of information you must know to control your bottom line. Hey, if you want to learn more about food costs, do me a favor in the comment section below. Tell me what topics you want me to cover. And if you like this video, click on the little like symbol, help a guy out. You might also want to subscribe now, where I will send you messages from YouTube that tell you immediately that these are up.
Well, he was just advertising for himself, which I don't hate, but we don't need to see. So, but he is right. We can accurately cost out and do everything properly, but when we're seeing what was used, quote unquote used, it is blind. We don't know where that product went. We just know it's not in our building anymore, and we need to have more systems in place to actually track what's going on. So this is where inventory management is going to become super, super important and helpful. And this is the process of tracking food and beverage products from the time that they're received until they are sold or discarded. Good inventory management helps restaurants by reducing food waste. So you might know that acronym FIFO, meaning first in, first out, meaning the first product that you received as a business needs to be put in front, and that is the first product that you are giving out. So this prevents spoilage. We also need to do everything in our power to prevent theft. That is very, very hard. You can't be everywhere at once, but having managers trained, having repercussions for theft, having cameras, all of those good systems in place will help you prevent as much as you can. But you should always anticipate a little bit. I know it's such a big pill to swallow, but it happens all the time. Avoid over ordering. So again, making sure that you have a nice organized workspace. You can see all of the product easily. Everything is in its place. It's and easy to read, easy to understand. This will help you prevent over ordering. And then you'll need to ensure products are available when needed. So definitely if you're working with seasonal products, make sure that it's actually available for you. And you'll want to calculate an accurate cost of goods sold. So really taking the time to do the inventory calculations correctly. And hopefully this will lead to some increased profitability. So those total inventory losses, he kind of mentioned it, but I'll just go over it again. So not every missing item was sold, unfortunately. Inventory can disappear for a lot of various reasons. Again, spoilage, expired products, overproduction, incorrect portion sizes, meaning the customer is getting too much, just straight up theft, if something was spilled, broken, and if you did not receive the correct product to begin with. Also accounting for employee meals, whether that is allowed or not. Those cooks are still going to eat. They're still going to give front of house some snacks. Like it's just a the nature of the business. And then complimentary meals, meaning anything that was comped out in front of house, like if you've ever had a dish take too long or there was just so many mistakes, they said, hey, you know what? This meal is on us. We messed up. We want to make up for it. And this comes as a loss to the business because you did not charge them anything, but you gave them something. So you'll want to define some budgets for yourself. And the way that you can do this is taking some projected sales to help define budgets. So, for example, especially after a business has already been opened and operating, this is an easy number to project. It usually is an average of what you've seen in the year or the months that you've been opened. And you take your ideal food cost percentage, let's put that really low at 20%. $40,000 times by 0.2, and we're looking about $8,000 that we can spend on whatever product we're trying to sell to stay within that budget. However, overestimating those projected sales can lead to profit loss. If you are too generous with how much money you think you're going to make, especially before a business opens. You really don't know how it's going to go. Then you have an inflated budget you're looking at, and you feel like you are on top of the world with that money, and you're not. So you'll want to maybe be a little more conservative when you're working with projected sales, because any expense that exceeds that projected cost is essentially just money being taken away from your profit. So, in the end, it is just very crucial to track all actual expenditures. So, anything that you spend money on, you'll want to monitor all of the expenses weekly, draw up those monthly reports, which is something that the POS system will help you with, and then compare those months to track waste and fluctuating costs. That's the best way to stay on track of all of these expenses. And then we cannot forget, of course, we are a business, we are a service industry. We have so much labor to account for. The average is about 30 to 35% of sales. So again, kind of matching, if not a little bit larger than the food cost percent, food and beverage, excuse me, cost to the business. Labor is going to be right up there with it. This does include benefits if offered and the taxes for employees, also the cost of payroll and the money disbursement, if you, especially if you have someone doing the payroll for you. And this is the area of the largest controllable expense, meaning we have the ability to manipulate this daily. So if you can, you should. The employer is liable for up to 50% of an employee's social security tax, also the entire federal and state tax for unemployment and workers' compensation, and then taxes for money earned through tips. So this is primarily for front of house, but sometimes when you're lucky, back of house too, you get tips. And payroll expenses are based on the gross pay of the employee. And just a little reminder about gross pay. Gross pay is the total amount of pay before taxes and deductions are made. So that nice large number you see, and then your net pay is when it's dwindled down because all these different taxes and money taken out for different reasons. That is the actual amount of money that you see come into your bank account when you get a paycheck. The types of employees that you'll often see in this industry are exempt, meaning that they are not eligible for increased wage for overtime hours. And before that reason, they are typically salaried, meaning they have a lump sum that they are guaranteed to get throughout the year. They still have taxes removed from that salary, but they are not eligible to stay overtime and get the 1.5 time pay like our non-exempt employees do, who are our hourly employees. You could be part-time or full-time, but if you hit over 40 hours, you must be paid 1.5 times your regular hourly wage to compensate for that extra time spent working. And we also see a lot of organized labor, also known as unions. This does increase the cost of labor for food service operators because unions are paying their union members higher wages and can pretty much guarantee a 40-hour work week. And this does prevent some food service operators from practicing labor control techniques, again, because they are operating on a contract. The unions have a contract with the food service operator, and it does require them to follow some very strict laws. So if you ever worked with a union or if you're part of a union, you'll know what this is like. But it can be sometimes a tricky situation to be in, especially in our food service businesses when a lot of it feels like the Wild West sometimes. But it does benefit the employees greatly. So don't let the idea of unions scare you, no matter where you are in the business. And to wrap it all up, our point of sale or POS system, not to be mistaken with another acronym of POS, because these are glorious, magnificent machines that help us do so much work that we once had to do by hand, and now it's done for us. So we use these systems to process orders to the kitchen. This is where you're submitting what your customers ordered with you to the computer, and then it sends a ticket into the kitchen, whether that's an actual physical ticket or it's just something that pops up onto a screen. This is where we print and process guest checks, so we don't have to do this by hand anymore. And then it does, because it's processing all of the orders, all of the money, it is helping us track our daily operations, and it will generate financial reports for us. Super easy. This does help to minimize human error, of course, because it can help us track inventory based off customer orders. It will help track sale of menu items to determine profitability. It will track busy periods to aid us in our scheduling when we should have more of our employees on and less employees off, or less employees on. There we go. And then it does actually, some of them help remind staff to clock in or out based off of the schedule if you have it all linked. So it could be really, really beneficial to use it in all its capacities and all of its offerings to the business. However, we learn about all of the math that these systems are built off of because we need to understand what is going on. Sometimes the machines can still make mistakes, and if we understand the underlying math, then that's when we can catch those mistakes in real time and get them fixed. So that does wrap up this week. Like I said, a lot of it was conceptual advice, meaning we're not doing anything like really hands-on. We're learning about the business and all the expenses involved. So what we're going to do in class is go through some beverage costing examples. It should be easy, but just getting out of that metric system might be the most tricky part about it. We'll talk about those two pricing methods and then cost some different things out using both of them and compare them. And then we are going to take a look at some inventory sheets and then projected profit and loss statements. So getting a little bit more into like managerial math with restaurants, but not too knee deep because there's so much to learn about that once we get into it. And we're just at our end. So thank you for sticking with me. This PowerPoint, it wasn't as long as some of our other ones. And I will see you guys in class. Bye.